we have a feature presenter that I'm so excited to present to you. Dominick Anton, registered agent, wealth manager. This is AVID Investors. Welcome to the club.
Excellent.
Thanks for being
Yeah,
here.
no, thanks so much for having me. Super happy to be here. Great to see you all.
And
Oh yes.
I owe you more than just a clicker.
Okay, very good. I'll throw it on my tie, perhaps.
That part's
All right.
yeah.
Okay, cool. Alrighty. So excited to jump into it. Quick show of hands. Who attended AVID last month? Okay, excellent. Well, so Stacy and I were talking, and we thought it'd be a really great idea to really just kind of go into and understand. Okay, so you've accumulated some real estate, and perhaps you're a little tired of continuing to manage the properties. What are some of the exit strategies, and how can we potentially unwind it in a tax efficient manner? I mean, who in this room loves paying taxes? Yeah, I didn't think so, right? So taxes, are a huge part of, investing. And, when your investments appreciate successfully, yes, there's likely going to be some taxes, but, there's tax avoidance, which is illegal, and tax evasion, which will get you in jail, right? So we want to stay clearly in the tax avoidance lane. Now, one of the questions I was asked in the last AVID meeting was about goals. And Stacy was really trying to dig into, like, who as an AVID investor, who set goals, who's accomplished some of those goals. And so I wanted to lay the foundation for the presentation, with that in mind. There's a phrase that I heard, and it's always quite stuck with me. And the phrase is, your money doesn't matter if you're not living a life that you love. And when we think about, wealth and what we want it to do, it's great to have goals. We obviously all need goals. So as real estate investors, maybe it's a certain number of doors or a certain dollar amount that we want to accomplish. But I would encourage us all as investors to dig a little bit deeper. What are we trying to accomplish through that? Is it being able to spend a certain amount of time with family? Is it being able to afford a certain lifestyle? And so as you think about your wealth, I think we can be thoughtful in the way we design it to achieve those personal outcomes. I've worked with all sorts of different individuals throughout my career, and I've seen time and again, if you don't dig deeper on those goals, you can be hitting a certain dollar amount. Maybe it's $5 million, $10 million, whatever that dollar amount is. But once you hit it without those deeper roots, it's not fully satisfying, and you start thinking about, okay, well, what is the next goal? I'm just going to chase and chase and chase until accomplishing that next goal. So we're going to look at several different considerations to think about how we can unwind certain positions within real estate in a tax efficient manner. And so really my goal with this is to give you an understanding of the different options that are out there, and what might be right for one investor or one family is going to be different from another family. And again, that's why having clarity on the outcomes and the goals that you're trying to accomplish is so very important. So the four things that we're going to dive into and look at is ways we can stay within real estate but be more passive in the way we hold it. The second is kind of an addition to that. And this more falls into the category of investors who will eventually need a little bit more liquidity, and that real estate position is not necessarily going to be a long-term hold. The third are some alternative assets that you can implement upon a transaction to help mitigate and reduce some of the tax exposure that comes with long-term capital gains and appreciation that's happened. And the fourth is far more liquid option to consider. So with that, let's start to dive in here. And again, I think this illustration here does a really good job of setting the importance of looking at the different options and having a good, clear strategy. Of course, you're going to want to incorporate your tax professional in these considerations, because if we don't have a good strategy, we're going to pay a significant amount in taxes. I'm not going to belabor the entirety of this example, but we will go through it high level. So let's say we bought a property, 15 years ago for $300,000. It's appreciated in value. Now it's worth $650,000. Over that 15-year period, of course, IRS requires us to take depreciation, right? And so we depreciate the property. The new adjusted basis of the property becomes $136,000 because of the depreciation that we've taken. So how do the taxes on this transaction play out? Well, because the IRS has given us a tax break on the depreciation, they are going to assess what's called a recapture of that depreciation that you've realized. Moreover, there's some Idaho state specific components for that, which is outlined here. And then we also have our long-term capital gains that we need to be aware of and be prepared for. So on this specific example, this investor bought this property, held it for 15 years, bought it for $300,000, sold it for $650,000. On this transaction, they would owe roughly $140,000, right? So how do we push that number down as much as we can? So that is a big question that we're trying to solve here. Does this make sense to everybody? I see everybody's eyes kind of glossing over a little bit. I'm not sure if it's because of me or just the taxes.
So that's 140,000 in taxes.
And taxes. So they bought the home for $300,000. They held it for 15 years and they sold it for $650,000.
So $350,000 in profit, and then that's a pretty big percentage of that.
Right. Yeah. Pretty significant percentage. Correct. Yeah. Okay. All right. And so I noticed when Stacy asked how many people are, self-managing, I noticed there's a pretty high percentage that came up. And certainly there's days where if you're managing the property, selling, some of these properties can start to sound very appealing. It looks like we have a question in the back.
Recapture rate, what is that? What's that amount? How does that calculate?
Yeah, so super great question. So there's something that's called the maker's schedule. This is an IRS schedule, which allows investors, which requires, shouldn't say allow, requires investors to take depreciation on the value of the property every single year. So in this specific instance, the annual depreciation was $10,909. Okay. And so, the investor bought the home for $300,000. We apply this annual depreciation, and the total depreciation amounts to this $163,000. And so, 25% is, what it amounts to the recapture of the depreciation.
25%.
Yeah. Yeah. Of course.
So the Fed basically wants 25% of their depreciation.
Right. Yep. Yep. Cool. All right. So as I outlined earlier, one of the options is to maintain your real estate exposure. We can do this through 1031 exchange. Who here has heard of a 1031? I assume vast majority of us. Okay. What I'm kind of surprised to find is that not everybody's heard of what's called a DST, a Delaware Statutory Trust. This was DSTs were allowed to be included as a 1031 option in 2004. So they've been around roughly 24 years. But this can be a really good option, to maintain the real estate exposure. But instead of being limited to a certain geographic area, now we have essentially the ability to hire a professional investment manager, and they can buy Class A real estate across the United States, right? So it doesn't have to be in Idaho. It can be in New York or California, Washington, wherever. Moreover, we are hiring this investment company to, professionally manage the property and real estate holding for us. So we have no involvement associated with any decisions in replacing toilets or roofs or whatnot, right? So, that's the benefits. The downside is that we have no control. The DST sponsor, the company providing this as an option, they're of course going to have a management fee. Now, these DST programs typically last anywhere between 5 to 10 years. And within that period of time, you're going to receive, your rent checks, which are typically distributed either on a quarterly basis or on an annual basis. But in order to, quote unquote, like sell that position, you're going to be in a position where you're in an illiquid market. So generally speaking, it's a very illiquid investment until that cycle has ended. Now, once the sponsor of the DST has decided, okay, now it's a good time to exit the strategy, we're going to sell it to a pension fund like CalPERS or CalSTRS. At that point, you have an option. You can take your capital, receive it as cash, pay the income taxes that will be due on it, or you could do another 1031 exchange. You do 1031 exchange in a property that you're purchasing here locally. So you do have options, with that. So again, I think, key points to know about this, defer the taxes, no landlord duties, additional diversification, and passive income. Those are the key points and key drivers as to why people would choose to go into that. So all that makes sense so far? Okay, great. Any questions? Go ahead, Rick.
I'm in a DST as a result of a 1031, like that. It's with Pasco.
Okay.
Fairly known company, and it's done really poorly. So it's, in my mind, they're kind of like a syndication.
Sure. Yeah.
And my brother's been in a number of other syndications, and none of them really have performed very well. So it seems like you're kind of better off just doing your own investments than let somebody else.
Sure.
Report it.
Yeah. Well, I can't speak to the investment strategies that you guys are in, but I think the DSTs that I've seen and helped clients place, it really depends on your overall risk profile, and you need to be working with a good manager who's doing good underwriting of the subset of the opportunity and also has good management, right? So I would encourage anyone, Rick, to your point, if you are going to perform, one of these, invest in any of these DSTs, it's really important that you take a deep look at the sponsor, the strategies, and the history that they have in place. There's a lot of DST companies that will have a public track record of the investment strategies and how those investment strategies have done. Right now, past performance isn't any guarantee of future results, but as Mark Twain said, the past doesn't repeat, but it sure does rhyme, right? And so you can look at certain asset classes and understand, okay, right now is a really good opportunity in senior housing, or right now it's a really good opportunity in self-storage. And so you can be really selective with what you do. So
do you see some of the ones, do you see them hitting their goals, and some hit it, some don't, and you look at whether they're performing? Yeah,
I mean, so there's always going to be some things that are outside of your control. I have an investor right now who has a DST and some housing in Arizona, and the cap rates are very good. Unfortunately, the builders, built an oversupply, and as a result, it is pushing the rents down, right? So you're always going to have some challenges, but that aside, every single client that I've helped with this are very happy with making the decision, and there's that clarity as far as why they're doing what they're doing. The long-term performance is, aside from that short-term setback in Arizona has been solid.
When you do one of these, you have to defer all your gains off of the sales, so you can't, I want to pay myself 20 grand and defer the rest. You have to defer it all.
No, that's a super great question. I'm so glad you asked. And the answer is no. So let's say you're selling a property for $1 million, right? If you wanted to say, okay, I only want to do 100,000 into one of these DSTs, you have the option to do that. Now you do need to be working with a good qualified intermediary to make sure that the distribution of the assets go according to the IRS code and regulations. But I have had instances where clients have sold a commercial property or multiple residential properties, and they didn't find a replacement property to complete in their area locally to complete the 1031 exchange, and so this DST was kind of a fallback option, right? So it's just another really nice tool to have in the tool belt. All right, great. Any other questions?
We just brought it locally, but a 1031 applies to 50 states.
Right. The 1031 it's IRS tax law. So it's Yeah, and anywhere, domestically in the United States. Yeah. All right. So to make things a little bit more complicated, right? Some of these 1031 exchange programs, realize, hey, some of these investors will need access to, the dollars, the real estate dollars that they've invested into, the 1031 exchange. And so really there's an option to be able to convert, a 1031 into what is called a 721 UPREIT. So, both the 1031 and the 721 are referencing a part of, the IRS tax code, but essentially the high level structure of it is that we're converting, the 1031 dollars of the DST is converting into a more liquid real estate fund option. So this is, a good consideration for a real estate investor who does realize, like, hey, yes, number one, I want to continue to hold real estate. Number two, I realize in 3 to 5 years, I may need to tap into some of these dollars. Now, on the withdrawal from the 721, you still have the tax exposure, which I kind of outlined earlier, right? So you still have the long-term capital gains, the recapture of the depreciation, etc. So all that would still apply, but you're not stuck in an illiquid market, right? Very similar, to the DST. You're using, a professional money manager. They're making decisions on your behalf. You're receiving distributions throughout the year. So, it maintains and holds a lot of the same advantages. And, again, has very similar downsides. Only with the 721, you're reducing not being able to access, the dollars and sell a portion of the real estate position if you needed to. Okay. Okay. So, these next two sections here are more for investors who have decided, okay, I'm looking at my overall net worth. I realize I have a very significant amount of real estate in terms of, an asset class, and I want to start to diversify out of just being in real estate. I want to have, access and part of my portfolio be in commodities or be in, publicly traded stocks. These two strategies can layer in nicely on a transaction. So one of, and I'll start with the oil and gas. There are oil and gas drilling funds, and within the IRS code, the United States wanted to incentivize individuals to invest in developing and creating more wells to produce more oil for our growing, nation. And so the origins of this law date back to 1913. And some of these private placements provide what is called an above the line deduction. And it's up to 80 to 90% of the overall amount that gets invested into the oil and gas fund. So if you're investing, $100,000, depending on the program and the specifics of the program, you could, have an above line deduction between $80,000 to $90,000. Okay. So, the advantage, from a tax perspective is it's incredibly, tax efficient. Moreover, it provides you additional diversification away from real estate. So instead of just, having, this real estate holding, we now have, access to holding oil within your overall portfolio. And that cuts both ways. Right now, the price of oil is very high, right? So as the wells, produce, there's going to be a flow through on the distributions. When the price of oil is higher, you receive, higher quarterly, revenue streams. When the price of oil goes down, those, distributions will also decrease. So the other, disadvantage of this strategy is, these programs are typically long-term holds. So, they're between 10 to 15 years is, very typical of what I see. So, provides a really great upfront tax benefit, but you do need to be invested in the program for a solid period of time. Historically, I've seen these programs return investor capital anywhere between 5 to 7 years. So as use that example of $100,000. If an investor invested $100,000 in by year between 5 and 7, depending on commodities and the price of oil and how things play out, they've in distributions they receive the entirety of the initial capital that they've invested. Of course, investment results may vary, right? But that's what I've seen based upon historical client accounts. So it's different. Just like with the DST, we have a professional manager. There's costs associated with their management, but it is a very interesting consideration. So I'm going to pause there. Does that all make sense to everybody? Okay.
So I think what you're saying is, if you sell in real estate, for the example, and you want to avoid the taxes legally,
right?
You could use this oil and gas method to harvest losses to offset the gains, the tax hit.
I mean, the IRS views it as it's called the intangible drilling costs, and so it's above the line deduction, so it's not technically a loss.
Okay.
Yeah.
But basically,
right.
You're getting hit hard. You're paying $140,000 in real estate taxes, but then you're getting an $80,000 to $90,000 offset of that.
Correct. Right. Yeah. So this is
down to whatever 50,000 in taxes instead of 100.
Right. Correct. Yep. No, that's very good. So this, I wouldn't say we would want to put the entirety of the proceeds of a real estate transaction into this. So typically when I'm working with clients, it's this in a combination to several other things that we're doing. So we do need to be conscientious of not having too significant of an over concentration to any one specific sector. Yeah. Alrighty.
Can you put that money in stock, or that's what we're talking about, or do you have to go give and invest in an actual company that's drilling and be a partner on that? How does that?
Yeah, no, so super great question. In order to receive the benefit of the intangible drilling costs, you're investing into a limited partnership. So in year one, you're considered a general partner. After that first year, you transition to becoming a limited partner. So with this, you're not actually going out and like buying into specific wells. There's a program manager who is selective about choosing the wells, when to drill, who to partner with, and again through that the tax benefits flow through. Yeah. So cool, great question. All right, now the other thing that I want to talk about is something that's called direct indexing. Who here has heard of the term direct indexing? Anyone? Okay, mutual funds. Everybody should probably have heard of mutual funds. Okay, what about ETFs? Okay, most people are familiar with ETFs. So slow me down if I get too excited about this, because this is a really interesting innovation that's happened in the investment world. So when you buy into a mutual fund or you buy into an ETF, you're gaining exposure to a specific sector or investment category, and it's all bundled in one instrument, right? So for this example, I'll use the S&P 500, okay? So a little over 500 publicly traded stocks in the S&P. But if we wanted to gain exposure to the S&P 500 using a mutual fund, we could go to Fidelity, we could go to Vanguard, and they have an S&P 500 option. We wanted to gain exposure through an ETF, we would buy SPY. Now, the market, the S&P 500, will go up and go down. If we look at the variance of how companies within the S&P 500 increase and decrease, there's significantly more variance, right? And so what direct indexing does is it takes the ETF, right, and essentially instead of holding it in one instrument, it breaks it apart. So now we're buying individual shares into a whole bunch of companies. So if you look at the holdings of the S&P 500, your holdings within your portfolio are going to be very similar. Now, what is the tax advantage to this? let me give you, a small example, and hopefully I don't make this too complicated. But if we wanted to gain exposure to, um, you know, consumer products, we could buy Pepsi, right? We've all heard of Pepsi. We've had, some Pepsi products here tonight. Now, Pepsi will trade up and down depending on the overall economic cycle. There's periods of time where Pepsi is going to be doing great. Could be up 5%, could be up 10%. There's other periods of time, maybe we're going through a recessionary environment, and Pepsi's trading down from what we originally purchased it at. What direct indexing has the ability to do is we have the option to sell Pepsi and buy Coca-Cola. This allows us to maintain the exposure, but realize the loss on the transaction, right? And those losses can be carried forward and applied to when we go to sell real estate.
Wow.
Okay, I heard the light bulb go off, which is great. So, really, the super cool thing about this is when you have the right direct indexing strategy, it just makes the whole process of owning assets less, burdensome, right? And again, we can use it as an instrument to offset, capital gains exposure now and in future years. There's typically minimums associated, with this. So a lot of these strategies require anywhere between 200 to 500,000. Some that go as low as 100,000. They do adjust some of the features that they provide depending on the dollar amounts. But it provides you with a ton of control and a ton of ability to skew your portfolio certain ways. So if you said, hey, there's a certain company that I don't like, I'm not going to name any one company. Can we exclude this company from the portfolio? The answer would be yes. So if you're heavily concentrated in real estate, we can make sure that we're not having any real estate or related holdings or companies within the direct indexing portfolio. Moreover, let's say you're highly compensated, employee working at a tech company. Perhaps you're at Micron, right? And you have a significant amount of RSUs. In that specific instance, within the direct indexing portfolio, we wouldn't necessarily want to have a high concentration within technology because you already have that exposure within your portfolio. So above and beyond that, I haven't even touched on estate planning considerations, but this is very liquid. So at any point, you could sell, request cash. If you're planning to pass assets down to heirs, again, it's very liquid, very easy to do. It's very easy to distribute assets from this. The downside of it is now you're invested into the S&P 500. There's going to be periods of time where the market's up significantly, periods of time where the market's down significantly. So you have to go into it knowing and understanding, hey, this asset might be a little bit more volatile. If you're, own a single family home, you might see go up, $5,000 Zillow or, down $10,000 on Zillow, but there's not a too significant amount of variation. Okay. Any questions on direct indexing? Okay. So I tried to condense this down as much as possible into looking at these categories, side by side, these options side by side, and helping to break down the pros and cons and, kind of where they fit in the bucket. So, by, doing a 1031 exchange into a DST, yes, we're deferring taxes, has limited liquidity, still in real estate. And it's just, again, we receive the benefit of the tax deferral. With a DST, with the intention to put it into a 721 UPREIT, we're deferring taxes. We will have eventual liquidity. A lot of these programs make you wait a period of time before the transition takes place into the 721 UPREIT. Still in real estate, the tax benefit, the primary tax benefit is tax deferral. The oil and gas, drilling fund, there's not necessarily a tax deferral up front. However, we do receive the benefit of the intangible drilling cost, which creates an above the line deduction. We do receive distributions from it. If you need to sell the entirety of the position, again, it's an illiquid market, so you'd have a very hard time doing that. So for long-term money, would not necessarily recommend, doing a program or strategy like this. The benefit of, investing in this is it is increasing the overall diversity of your portfolio. Direct indexing, if we're, investing in that, it's not providing, in any sort of immediate tax deferral. However, it is fully liquid, it is diversified out of real estate, and we have the benefit of tax loss harvesting, which can help offset future gains. Okay. So hopefully this is a helpful, breakdown for everyone. So, big picture when I'm working with clients, things that, I want to dive into with them before we start allocating dollars is just having clarity as far as, again, the end goal. How do we make sure that, with your end goal, how do we make sure we have all of your essential expenses, now moving forward, completely covered, and assets that are not going to deviate significantly? Moreover, how are we going to make sure that your portfolio grows enough over the long term so you can afford, doing the lifestyle and, be it big experiences, so travel or, specific car or investing in a family trip. How do we make sure that, we're positioned to be able to, provide that? And big picture in terms of, legacy, what dollars are intended to not only be for your use, but for, future successive generations. So when you start to look at the investment, opportunity subset with this lens, it really starts to help individuals start to narrow down and understand, hey, I need to have X amount of dollars in this bucket. I need to have X amount of dollars in this other bucket. So this is a slightly different framework that we can use. I'm not going to go too deep into the details on this. Stacy, how am I doing on time?
You're doing great.
Okay, so if I have, I guess, a few more minutes, then I'll jump into this. So looking at clients in where they hold assets, like anything you're going to be using between 0 and 2 years, those should be in very liquid asset classes, be it cash or treasury bills or money markets. And upon each longer duration time frame, we can get more and more aggressive in terms of the appreciation potential. But with any sort of appreciation potential, there comes the downside potential. So again, having that clarity and having that framework really helps investors be able to understand how they can position certain assets. Okay. So when someone will come to me with a situation where, like, hey, I have this rental property, I'm looking to sell. That's the framework we use, and it's typically a combination of things that we're employing to make the whole process and the whole transaction as tax efficient as possible. So maybe part of it's a 1031 exchange, maybe part of it is investing in oil and gas. With a 1031 exchange, we'll dive into the pros and cons of the UPREIT. Maybe it makes sense for the risk profile. Maybe they want to be a little bit more aggressive and keep it in the DST. And then also implementing investment strategies in the most tax efficient manner as possible. I will say with the direct indexing, you can use it the year that you're realizing a gain, but it can also be used well in advance, right? So if you know that you're gonna have a real estate sale within the next 5 to 10 years, you can implement that strategy and start benefiting from the losses to be able to carry that forward for that future transaction. So yeah, I mean, and some things to think about, right? So maybe some of these things resonate with you, but typically what I will see is as people transition into the retirement years, the amount of time that they want to spend in managing a rental property will typically decrease. I have a client right now, he's in his 80s, he has 2 rental properties, he's slowing down. He realizes he's probably going to pass before his wife, and his wife is not, suited to manage and make decisions about these rental properties. So he's like, a perfect candidate to looking at, some of these DSTs and some of these other options. And he's done. He's ready to be out of these properties, right? sometimes, individuals are concerned about having too much in one particular asset. We've benefited from Micron and the whole AI boom that's taken place and has created a lot of millionaires over a short period of time. But on the flip side, like, okay, what if the bubble pops, right? What is that going to do, to real estate here? Is there going to be any sort of impact? So I think, having, that clarity and understanding, not being overly concentrated can be beneficial for people to be able to sleep well at night. There's estate planning considerations, right? Maybe you have some children and maybe they do want to be in real estate, maybe they don't want to be in real estate. If a very high percentage of your overall net worth is in a couple properties, that can be problematic. How do we split, the property so that each child receives an equal share? So there might be some estate planning considerations to make sure that the successor trustee is able to distribute assets according to your intentions, in a way that's equitable and as simple and easy as possible for everybody. So again, all things to think about, all things to consider. So big picture, I think looking at the overall position and understanding where you're at. I'm sure most of you work with amazing tax professionals, but if you are looking to sell a property, I think looking at the taxes and the tax liability, that's a really great starting point. So understanding, okay, what is my long-term capital gains exposure? What is my adjusted basis of the property? How much am I going to potentially pay in depreciation recapture? And then from there, that starts the framework, the foundation for how do we solve and how do we mitigate this tax bill as much as possible. That way we keep those dollars in your pockets and going to heirs as opposed to Uncle Sam. So big picture. Hopefully this gave each of you some solid ideas and some solid considerations and an opportunity to understand what's available and what's out there. Full and fair disclosure, I'm very optimistic about Boise. I love the Boise market. I think there's a lot of appreciation potential. So I think there's a lot of really great opportunities to continue to stay invested in Boise. But this is really a great off ramp, to understand. Okay, if I'm done holding real estate, how do we make that transition as tax efficiently as possible?
Ladies and gentlemen, Dominick
Yeah,
Anton.
yeah, thank you.
Thank you so much. Don't go anywhere.
Okay.
Wow. Is anyone else's head mind explode? I'm going to try to do a summary,
Okay,
but
please, let's do it.
I don't know what we got here.
Let's knock it out.
Okay. AVID Investors Club, Dominick Anton of Two Rivers Wealth.
Twin Rivers. Retake.
Okay.
There we go. Take two.
AVID Investors, we have Dominick Anton with Twin Rivers Wealth. I'm StacyA McBain with Swope Investment Properties. And when we get involved in real estate, we may not always have goals in the front of our minds, but it's an important piece of the puzzle. And chasing goals is not a satisfying goal. Using wealth that we've gained to live the life that we want, that is a satisfying goal. Covering our expenses with the assets we've worked to invest in and maintain over the years, that's a satisfying goal. Avoiding taxes is a big piece of that puzzle once you're trying to do that. Because in the example we looked at today, on a $350,000 profit, a whopping $140,000 could go to taxes after depreciation recapture. So we do need tax efficiency in our lives. And so what are the options if you don't want to 1031 exchange when you sell real estate and you do want to be tax efficient? We looked at Delaware statutory trusts, DSTs, for a more passive kind of mutual fund like 1031 option. You lose control, but perhaps you gain time. You're not fixing toilets and you defer your taxes just like a typical 1031. Dom taught us about REITs via a 721 exchange where we can convert the DST then into a REIT. We looked at oil and gas as a method of creating a large deduction or a loss to offset that $140,000 tax hit. And that's a longer term gain, longer term hold. And we looked at direct indexing, which is just a sort of call down if you want to hear about that mind bender. But where you harvest losses with individual trades to create your own investment mix. And the purpose of all this, or the pros and cons to evaluate as we make considerations at this level, would be looking at liquidity, looking at estate planning, tax efficiency, and then based on the complexity of some of these, I'm convinced that you make sure you're considering the right mix as evaluated by someone who knows how to make it work and how to make these things work to meet your goals more than you do.
You nailed it.
Dominick Anton,
Yeah.
thank you
Yeah.
so much.